So I'm very pleased to present Peggy Farnsworth today. We're presenting Learn is the organization bringing you all of these free webinars. We're a lifelong education and aging resource network. We're an Idaho-based nonprofit that has a mission to provide quality community education on retirement and aging related topics in the area of health, wealth, lifestyle, and caregiving. And Learn is a CSA Leaders Network organization. And just as a disclaimer today that the content is provided for general information and as reference purposes. It is not to be considered legal, financial, or health advice. Please reach out to your own legal, financial, healthcare personnel just to verify the information that you're learning today is appropriate for you before you take any actions on it. I would like to recognize our wonderful sponsors for the fall series. So every quarter we have sponsors that allow us to bring this education to you free of charge. And this quarter sponsors are Oasis Senior Advisors and Red Pheasant Realty. And they have made this possible for us to present this to you free of charge today. And with that, I'd like to introduce our speaker, Peggy Farnsworth. She is a member of Learn and a Boise retirement coach. So Peggy, take it away.
Okay, well, you get my slides loaded. I will share. I come from the accounting and finance arena. My whole career has been spent in that space. I started out in public accounting and then decided I really liked the financial planning and moved to the financial planning probably 25, 30 years ago. But the last 10 years, I have been focused specifically in retirement coaching, preparing people to get ready for retirement, transition through retirement, and then manage the golden years. So that has been my focus and purpose, and Social Security is definitely one of those pieces that you want to use effectively in your personal financial picture. Okay, so we can go to the next slide. So your Social Security benefit is determined by your work history. Next. And you earn up to 4 credits per year, and each credit next is worth 1,470 per work credit. So you can only earn 1 credit per quarter. So if you earn more than the 1,470, you still have the 1 credit, but it's 4 credits per year for your benefit picture. Next slide. Okay, so high income earners next will get 20% of their average income in their benefit. Next, that will be the average of 1,543 in their benefits. Next, low income earners will get more like about 50% of their income. Next, there is no minimum benefit. This is a safety net that is designed to help prepare and keep you from having nothing, but there isn't a minimum. It is strictly based on what you have been earning. And so being sure that your Social Security benefits get reported is a wise thing to do. Cutting corners and trying to avoid paying Social Security tax may or may not benefit you in the long run. Next slide. So when can you claim your benefit? Well, if you were born between 43 and 54, you can claim it at 66 years of age. Next. But if you were between 55 and 59, then you're going to add 2 months for each year over 54. So if 54 plus 2 months, 54 plus 4 months, and next, all the way till we get to the year 1960, and then it's just a flat 67 years, which makes the math a lot easier. Okay, next slide. So should you take your claim early or should you claim late on your Social Security benefits? Well, let's take a look at that. At age 66, if we use full retirement age of 66, you can see on the slide that it's 100% of your full retirement benefit at that age. If you should choose to take it earlier, You can't take it before 62, but look at if you start at 62, your benefit is at 75% of the full benefit. Come back, come back.
I'm going. I clicked the wrong one.
Your full benefit is 75%, or you've taken a 25% reduction, which may be more than you want to give up. So let's take a look at the other direction. If we start at age 66 at 100% of benefit, and then we delay, we can add a benefit 8% each year, so that when you get to age 70, you're at 132% of what your full retirement age benefit is. However, if you're a 67-year person for full benefit, full retirement benefit, then you only have 3 years that you're adding, so you'd only be getting an additional 24%. But it is still probably worthwhile for you to wait till age 70 to get that full retirement benefit. Okay, let's take a look at the next slide. We're going to show you what that looks like with the real numbers. Next. So if we assume a benefit of $1,000 for somebody that's at age 66, you can see in the middle of the chart, that kind of blue is at age 66, is $1,000 benefit. Then if you go down to the very end of the chart at age 62, you're looking at, you've given up $250,000 or $250 a month permanently. Or if you go up to age 70, you're at $1,320. Now, I can definitely think of something I would like to spend my monies on for $320 a month. That's a lifelong change that you make. So it's worth waiting the additional years. Doesn't mean that you can't retire till age 70. It just means that you use other sources for your income. Next. So what should you choose? Well, that depends on your current health situation. And it may be that if you have a critical health situation and you need to and can't work, you may need to start claiming earlier. Or what your current cash needs are. If you are gotten into something of a jams financially and you're working and you still want to take in your Social Security benefits because to you that's cheaper than taking a loan, that might be an option. Next. Or your family longevity. How long does your family live? If they're living into their 80s and 90s, then you may want to choose to go with the age 70 because you'll have a larger dollar amount for a longer period of time. Next. Or if you don't have other sources of income and assets, if you're not going to continue to work, if you don't have retirement accounts set aside, that's what you want to be looking at is how can I fund my living expenses without tapping into my Social Security benefits. And most people are able to do that. It feels a little uncomfortable because you're taking out of those retirement accounts that you have been spending time putting in. It's that emotional, psychological shift that you have to make to start taking that as a paycheck. So, but that is better than taking a reduction in your Social Security benefits just to avoid taking money out of your accounts. Next. So if you plan to continue to work, that would be a consideration as well, because you have limitations depending on what age you retire or decide to take Social Security benefits that will impact you on what happens to your Social Security benefits. Okay, next slide. So your break even. Next. If you claim early, then that occurs between age 75 and 76, depending on when you were born. So if you take a reduction in rate to be able to start taking your Social Security benefits early, then if you live past age 75 or 76, you have left money on the table. That's what you're looking at. It may make your life easier then, but having more monies at a later date could be a benefit for you that you may not want to give up. Next. So if you delay your benefit, your break even occurs at about age 79. So If you think that you are going to live past age 79, what is the longevity in your family history? Perhaps you would want to delay. Now, in our household, my husband has good gene pool. They have family members that have lived into their 90s and well into their 80s. So we are deferring his Social Security benefit until he reaches age 70. However, my gene pool's not so good. I have one aunt that lived past 80. Most of them died in their 60s and 70s, and my mom died at 77. So I'm not going to choose to go to age 70. I'm going to look at taking my benefit at full retirement age. I am not taking it at reduced rates because I don't want to be penalized for working, which we'll talk about in the future slides. Next. So remember, whatever you're choosing, a reduction or a gain, it is a permanent change. And I say permanent unless you decide to unwind it. I have an individual that she started Social Security this year because she was thinking that she needed it to be paying for her Medicare benefits. While we're looking at doing a Roth conversion, and her tax preparer said, well, you know, you can undo that. You can stop taking the benefit or pay back what you've taken. So you could do that, but it's better to evaluate it up front and make sure you're making the right choice and talk to your advisors before you execute on a plan. So, and looking at that next, whatever you're deciding that you want to give that careful consideration because the decision is pretty final. You can unwind it a little bit, but it's a few extra steps and it will complicate your situation. If you've gone for a few years, then you're kind of in a tough space. All right, next. So can I use my spouse's benefit? They will actually they will take a look at your situation and when applying for your benefits, and they'll evaluate, here's what half of your spouse's benefit would be, and here is what your benefit is. And they will decide which is the greater of the benefits that you could take. There's no longer a ability to file on one and then switch to the other. It is either or, and you decide at the point that you apply for. Next. So you will be paid the larger of the two benefits. Next. So what if the person is no longer my spouse? Okay, next. If it's a divorce, then you have an option. If you've been married 10 years and have been divorced at least 2 years, then the spousal rules apply. And you can apply against your ex-husband's or ex-wife's benefits. So, and I have a client that we did that. We took a look at her benefit amount, and then we took a look at half of her ex-spouse's benefit amount, and we filed against the ex-spouse benefit. It does not impact the ex-spouse or the ex-spouse's new spouse. Is not impacted there at all. They're just giving you the greater of the two benefits because you did spend the time with the individual that created the dollars that you can be applying against for your own benefit. Okay, and if you're not divorced, but you're widowed, next, then you have the option to be able to claim a widow's benefit, but you do have to wait until age 60. I have another client this was her situation, that she became a single parent in her late 40s and basically continued to raise her children on her own and work full time. So when she turned 60, she decided to go ahead and take the widow's benefit, defer taking her own benefit, and waiting until age 70 when she has the full benefit of time on that and adding that 8% a year. So she will have a much bigger Social Security benefit at age 70. And if you happen to do that, if you are taking a widow's benefit, you have to wait until you have reached, one, you have to be single, and two, you have to wait until you reach full retirement age, whether that's 66 or 67, before you can remarry in order to not lose the widow's benefit. It's just those little tricks of the trade and being aware of what you need to do or not do. Okay, next. So planning for the survivor is critical because the survivor receives either benefit they're currently getting or the higher benefit, whichever is greater. So that's one of the reasons why when I'm working with a couple, we usually make one spouse go to the age 70 and maximize that benefit. And the other we may take out at the full retirement age, but we go for that age 70 maximum benefit because if somebody predeceases or dies, then you still have that maximum benefit amount that is available. So we try to keep that as an option in play. Next. So 80% of the women survive their husbands, and on average, it's a 14-year span of time. Next. And 98% of the widows benefit recipients are women. I have seen quite a few men, but that must be that very small percentages in my neighborhood. Okay, next slide. So can you work and claim your Social Security benefit? Well, it depends on how old you are. If you are at the full retirement age of 66 or 67, you're good to go. But if you are under that amount, your earnings are capped at $1,580 a month or $18,960 annually. So you need to be careful at what you're earning in order to not lose your benefit. Next. But if your earnings are over the working benefit amount, you will be reduced by, next, $1 for every $2 that you're over the limit. So they will reclaim that Social Security benefit from you, but it's $1 for every 2. So you can do the math and decide how far you can go over before it's not worth working and taking your Social Security benefits. And if you want to be working because you're enjoying it, you can put your Social Security benefits on hold. That will allow it to defer and to continue to accumulate and could increase it nominally when you decide you don't want to be working anymore or you want to be working less. Next. Okay, so how are your Social Security benefits taxed? Of course, IRS can't do anything simple. So we have a formula that is designed to determine what is your provisional income. And that is part and calculated by 50% of your Social Security benefits. Next. And your ordinary income, which would be your wages. Next. Capital gains and dividends. Next. And non-taxable interest. And non-taxable interest is not included in your federal taxable income. But these are the pieces that come together to make up a provisional income. 50% of the Social Security benefit, your ordinary income, wages, dividends and capital interest, and any non-taxable interest, which would be on municipal bonds or something of that nature. Next. So looking at the provisional income, if that is over $25,000 as a single individual, then 50% of your Social Security benefits will be added into your taxable income. If that provisional income is over $34,000 as a single individual, then up to 85% of your Social Security benefits could be included as taxable income. Next. As a married couple, you get a little bit wider band that initially starts at $32,000 for 50% inclusion and $44,000 for an 85% inclusion. All right, next slide. So on our tax examples, we are going to take a look at next that how do we calculate how much of our Social Security gets added into the tax picture? And not all dollars are created equal in this scenario. So if you have $40,000 paid in Social Security and you have $20,000 as an IRA withdrawal, then your provisional income is $40,000. You're taking 1/2 the Social Security benefit at $20,000 with the IRA withdrawal of $20,000. So you have $40,000 of provisional income for that $60,000. So we take our $40,000 of provisional income and we compare it to, as a married couple, to the 32,000 because that's the upper threshold. And we have $8,000 that exceeds that $32,000 threshold. And 1/2 of that is 4,000. The second threshold of 44,000, we do not exceed, so there's no additional Social Security added. So for this couple's picture, you're looking at $4,000 of Social Security benefits being added into their taxable income, or approximately 10% of their Social Security benefits are taxed. Next. So you're looking at a second scenario, you have the same $60,000 being paid, but it's being paid from a different pocket. So you have $20,000 of Social Security benefits, but you have $40,000 of the IRA withdrawals. So it's 60,000, but your provisional income is 50,000, and that makes more of your Social Security benefits included in taxable income. So you get to 50,000 provisional income, taking 1/2 of Social Security benefit, 20,000, half of that is 10, with the IRA withdrawal of 40, and you're at 50,000 provisional income. So you take that 50,000 of provisional income less the $32,000, you have an excess of 18,000 and multiply that by 50%. And you have $9,000 being included into taxable income. But you also, in this situation, have exceed the second threshold of $44,000. So you have an additional $6,000 being taxed at it to equate to the 85%, or an additional 0.35. So 35.35 times the 6,000 gives you the 22,100. So the combination of the two is $11,100, or 55% of the Social Security benefits. A big difference in the picture is $60,000. The money spends the same way, but the amount that gets included in your Social Security, or of your Social Security that gets included in taxable income, changes dramatically. So you want to be observant of what you're doing with your Social Security and what other income you are including in your taxable picture. Once you reach age 70, kind of that golden age, you can be making charitable contributions from your IRAs or retirement accounts, and you can do that, what's called a qualified charitable donation. So what you're doing is making the contribution directly from the IRA account to the charity. And that allows you to reduce that, take that out of your total taxable income. But what did we just do taking it out of our total taxable income? We reduced our provisional income. Thereby, we reduce the amount of the Social Security benefit that would be added into that picture. Or what if you're trying to buy a car and you want to take some monies out to be able to do that? Well, where do you go to do that? You might give consideration, if you have a Roth, to be taking the money out of the Roth account. That way it's not increasing your provisional income and not increasing the amount of Social Security benefits that's being taxed. That's some of the games of chess that you're basically playing in order to determine what is the taxable position and minimizing how much your Social Security benefits are being taxed. Hopefully that was fairly clear. I don't see any questions. It seems to be understood.
So Peggy, I'll ask a question. To figure out if something would be included or not in provisional, is it your recommendation to reach out to your tax preparer? Does it need to be decided in advance? And do you have resources that you would recommend people go to help them figure out how to pay for something?
The tax preparer can assist you with, and if you prepare your own taxes, then just put, and I suspect if you do prepare your own taxes, you're using TurboTax. So you can just run it in the scenario, put the numbers in and see what it's going to do. How much of the Social Security benefit is it going to pick up? Because that Social Security benefits will tell you in Part A, here's the full benefit amount you received. And in Part B, here's the taxable amount. So change the scenarios and the picture you're running, and you can come up with what's happening with the taxable amount in your picture. As far as you can't go back after the fact and figure it out. You really need to try to determine where you're headed when you start, what the numbers are. We do a lot of Roth conversions at the end of the year so that we kind of have a feel for what has happened for people through the year. And we can determine how much we can convert from a traditional IRA to a Roth IRA to minimize their tax picture and not break into new tax rates. So that's kind of the same thing that you're looking at with the Social Security is after you want to do the planning ahead. And it may be that you're talking 1 year to the next year. It may be that you're just talking something comes up in the current year and you need to address it. I try to look at a 3 to 5 year range of what's happening with the family if they know and basically what their world looks like, so that we are doing the best financial planning for them personally and what their tax picture will be in the long term. We have, this is not Social Security topic, but the CARES Act and the Secures Act at the end of 2019 changed how the retirement accounts are left to beneficiaries. You no longer can stretch those benefits out over the person's lifetime. It is taxed in a much shorter period. They have 10 years to take all that money out. Now, they don't have to do it evenly over the 10 years. They can take it all up front. They can take it all at the end, but they have to get it totally out of the bucket within a 10-year period. So when you're looking at getting it out within a 10-year period, what are you doing to your kids? If they're high earners, you have just dumped a tax load on them. So what I have been doing with clients is we're getting as much of that out of their retirement accounts as we can, either converting it into the Roth or just taking it out for their personal use and watching what we're doing with their tax rate schedule. We will fill up the tax rate schedule that they are currently in with their current income situation, not paying any additional taxes for, but we are not leaving that benefit to the kids to have to contend with at a later date. Because I don't know what your experience is, but I have seen some pretty hefty retirement accounts of 500,000, million, $2 million. That's a hard piece to be. Probably the only one that wasn't really a big deal is when he has 6 kids, because you're spreading that out over more people. And so it's a less of a tax impact to the individuals. But that's part of what we're looking at in strategizing what you're doing with your cash flow and management of your retirement accounts and your overall estate and financial planning. It's a chess game. And some people like to do that, and others would just as soon like to hand off to somebody else to figure it out. So likely to have changes to our system for the future reference. We are looking at currently the maximum dollars that are taxable to the Social Security, to the 14.4 amount, excuse me, 12.4 amount that is taxable for Social Security benefits is $142,800. So that we can increase, and you can see by the coins on the side that we have had that steadily increasing, has been steadily indexed over the past few years. And or decades. And so it has been increasing, but we can make that go faster. Medicare, we just took off the cap. It's subject to 2.5 or 3.5% with the matching from the employer. We just took the cap off. All wages earned are subject to the Medicare tax. That could be done with the Social Security, that all wages are subject to the Social Security benefit. Or we could index it faster, so more of it is subject to the Social Security benefit. Next. So the other option could be that we gradually raise the full retirement age until it's 67 or maybe 68, so that you are delaying people starting to take the full retirement benefits. I think if they delayed the early start at 62 to 65 when it's Medicare, they would probably slow down people taking the benefits. You could be increasing the payroll tax from 12.4 to an additional 2 to 3% to be able to meet the needs of the Social Security system. But you have to have a Congress that is willing to work together and find solutions and not be about gamesmanship. They need to be actually for the best interest of the what the people need and what the systems need to make them whole, because there is a possibility of being able to do this. We were in the same situation back in the early 80s, 70s and 80s. I didn't really understand it at that point in time, what they were doing, but I am in great awe of what they managed to accomplish in that season, where they came together with a plan to be able to fix what needed to be done. And it made it from gave them another, 30 years, 40 years. But we need to do that again. And I think if they do it in such a way that there's a little bit of pain paid by everybody, I think that that is helpful. But those that are nearing Social Security benefits and receiving them probably won't see much of a change in their scenario, with the exception of Next. They will have impact the benefits because it will be chained. It'll be moved from being the CPI index to the chain CPI index. So the CPI index is the consumer price index. It is based on what is our inflationary pricing that is going on. This year, we're seeing a significant amount of that inflationary factor taking place. But what they do with the chained benefit is they say, okay, you have this basket of goods that you are using, and if the prices go up on those basket of goods, you're likely to change out. So if you have if you're buying steak and you can't afford steak anymore, so you buy hamburger, or your gas prices are getting too high, so you're carpooling more, or you're going fewer places. You're making choices to make the pricing work for you. So that's the chain CPI. They basically are reducing the amount of inflation factor that you would get benefited by. So your Social Security benefits will go up at a smaller amount than what they would if it was the normal CPI index. That would be the impact for those that are currently on or are soon to be on Social Security. That's how they would manage that. Again, I think we all need to pay the price for fixing the Social Security system. I think if we all give a little bit, it's not going to be as painful if we just hit the one side or just impact the other or have no benefit for the low income. So we need to get serious and we need to make some changes, but I don't know when we're going to get serious. Okay, next slide. So any more questions?
So what are your thoughts on the health of the Social Security system in consideration of your last comments on getting serious about fixing it? You know, where do you sit on the, will it run out? How will we preserve it?
They are looking at 2030 or 33, somewhere in there, that it will be running on fumes. And the challenge is we don't have when we originally started with Social Security, we had like 10 people per one person, 10 people working and paying into the system per one person receiving a benefit. So then it starts to dwindle down and you end up having, I think we're being supported, one person's receiving benefits and 2.5 people are supporting that. That's created some of the dilemma that we have fewer paying into than are receiving. Now, fortunately, I think it's this last generation. I don't know what it's called. It's not Gen X, maybe Gen X. But they're as big as the baby boomers. And that's good. Because we need that many people paying into the system to be paying for the size of the baby boomers that are coming into the picture and taking Social Security benefits. So that's our time frame. I don't know whether if we will get to a place to be able to be working across the aisle and actually find solutions. I don't think that's going to happen without people putting pressure on their local folks to be working out and making compromises and having those conversations. I think that they go with where the noise is and who's talking to them, who has answers and solutions. I was greatly impressed when the market tanked in 2008 and 9, and it just kept falling. One of the economists that I follow said, your problem is the market to market with making the accounting statements, and this is getting complicated, but it's the financial statements when you have to make them adjust versus just being the book value on it. That's what's creating this tumble in the stocks. So when they took that off of the books and backed that out, that's when things started to kind of find the bottom. But that was somebody going in and having that conversation. And that was 2 or 3 people coming behind that person and saying, yeah, let's make this change so that we can save what's going on and circumvent this spiraling down, because we're having to adapt every time the market adjusts downward. So if we can get there, if we had people, but we're so vicious in our communication and in our social media that it is hard to be the one that stands out there and says, this is the way we need to do it, or we need to quit spending. It's a hard space.
And do you, because of that, I mean, as part of the solution, and do you expect continued increases in both extension of the retirement age as well as increases in taxable income thresholds or maximum taxable
Well, they
income
already
per year?
have the Social Security is already indexed, but
only up to 70, right? Or 67.
The Social Security wages are already indexed for taxability. So are you asking, do I think they will delay when people can take Social Security?
Well, that's one question. Will that continue to extend, and will we continue to see the taxable wage grow, right? Where it was $90,000 in 2005 and it's $142,000 now.
Yeah, well, both, yes to both.
Okay.
The availability, accessibility to be able to claim your Social Security benefits will not be impacted. They usually give you a 10-year window. So if they're making it 66, 67, they probably won't push that out. They go to 68 or 69, it's going to be for somebody over here that is in their just 50. So they're a few years away from that going to be impacting them, that they have the ability and the time to adapt and make adjustments for that. So, okay.
There's a question here.
Popped up.
How will the tax scenario change if you are selling investments instead of utilizing IRAs to Roths to supplement your income once you start collecting?
Okay, so the tax picture would be that you only have the gain on the sale of the investment. So you would have, if you bought something for $100 and it's now worth $200 and you sold it, you have $100 of gain. So you got $200 in selling it, but only $100 of that is taxable, and that would be included in your taxable picture. What they're going to do with the capital gains tax rate is undetermined at this point in time. They are looking at increasing that rate right now. Get my cheat sheet. Right now, if you're married, you pay and you have capital gains, just 0% up to $80,000 of income, taxable income, 15% up to $500,000 of taxable income, and it's 20% if you're over $500,000 of taxable income. So it has a moderated, whereas at $500,000 of taxes, you would be paying under the current taxing system 35%. So they are bringing tax capital gains in at a smaller, reduced rate, and in some cases with no impact for an individual making a sale. That is the current guidelines. They are looking at making changes so that there is supposedly more being taxed on those that are higher income. And I can kind of see that if you're getting 15% at 500,000 and that tax rate is actually giving you 35%, yeah, maybe that person should be paying a little bit more in capital gains. Maybe they need to adjust those capital gain brackets. That's potentially what they could be doing. What they come to an agreement on is not going to be what Biden wants to have in place for the numbers. There's going to be something in more of a moderate adjustment. Again, it's kind of been a watch and see. I anticipate that there will probably be something, but whether we actually get it effective for 2021 or whether they'll be doing something in January of next year and it impacts next year, it is 50-50 on where it lands. I cannot tell you how many clients are in this waiting game to see if they push forward and do something this year or wait until next year because they didn't change the law or they will be changing the laws. So it's and that's why our market does this wobbly thing too. It's because they don't know what Congress is doing, and the market doesn't like uncertainty. They want to know.
Any other questions in chat or live? I think that might be it. Is that it? Is that the end of your presentation?
That
Peggy?
is.
All
Well,
right.
we have a couple of quick disclosure slides.
Okay, yes, we'll get there.
Yeah, so this is a workshop sponsored by Learn. I'm Peggy Farnworth with Securities America. And next, we land on if you have additional information or questions that are more personalized, you can reach out at the office and I'd be happy to assist fielding those questions.
Wanted to thank Peggy very much for her presentation today. It is such an important topic, and some of us are getting close to that age. So every time I hear you speak, Peggy, I learn something new. I thank you for your expertise and being with us today. I would also like to thank our sponsors, Oasis Senior Advisors and Red Pheasant Realty. And if you would like to join the Learn mailing list and are not on it, you will receive an email inviting you to join the list. You must confirm the subscription before we will add you. We don't just add people unless you choose to be added. So one way to find out about what's coming up next in our program is to be part of our mailing list. And then we're going to talk a little bit about the next events that are coming up. On the 21st, we have Winning Strategies for Family Caregiving. This is a program that Dara and I are presenting. It's a game. It's a lot of fun. We enjoy doing it as much as we hope that the participants enjoy it. Dealing with downsizing, home for the holidays, transitioning to care, and mindfulness for your health are the programs that we have scheduled for the rest of the year. So with that, I thank you all for your attendance and look forward to seeing you again at the next Learn session. Thank you.